Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 71 on July 20th, 2019. I'm your host, Eric. And in this week's show, we will cover the trades from last week on McDermott International, the Semiconductor ETF, and the Gold Trust ETF. And then we discuss three new trades on Knight-Swift Transportation, the iShares MSCI Brazil ETF, and Uber. Now, it's always great to hear from listeners. If you have any questions about the trades presented here or about your own positions, feel free to email me. You can reach me at eric@theweeklyoption.com. That's ERIC @theweeklyoption.com. And I really appreciate those of you who do email me. I get a kick out of some of the questions, which make me laugh. Just that, hearing the trials of you guys just trading options. Mostly it makes me laugh because I have shared experience. There are a lot of similarities in learning. And then I also love it just because it lets me know that you guys are out there listening and that I'm answering some questions. And I really take a lot of joy and pleasure from being able to help you guys along your way. So I've also created a short video series to teach you all the basics of option trading that you'll need to know in order to follow along with me on this podcast. You can visit our website and click on the videos tab to watch them, or just find the YouTube channel for the Weekly Option. Now, the stock market moved off of its highs from last week. The Dow Jones Industrial Average fell 177 points, ending the week at 27,154 points, and the S&P 500 index moved 37 points lower, closing at 2,976 points. So really not big moves week over week. There's always the day-to-day volatility that you have to be aware of because it affects your position. But the week over week changes weren't too significant this week, especially as compared to last week. Now, the topic of the week is sponsored by the Option Studio. If you want to learn how to trade options without any calculus and confusing language, visit the website to learn more about the online course. Visit www.theoptionstudio.com for more information. Now, the topic of the week this week is where to start learning more about option trading. So I speak to people all of the time who may not be ready to dive into an online course, but they'd still love to be able to just learn some more about option trading. So I wanted to go ahead and give a few suggestions. Really, it's three different books that I always point to for option trading. Now, the caveat, of course, is that these books are going to be a little more complicated, a little more complex, but I would challenge you to read them or choose one of them, and I'll specify which one, but choose one of them and dive in as deep as you can, and then come back and listen not only to the show, but possibly purchase an online course, because that'll take you the rest of the way. So the first book is what we used to refer to as the Bible of option trading, and that's Option Pricing and Volatility by Natenberg. It's a green book, typically green cover, and it is a fantastic book. It's, in fact, the company that taught me to trade options based the curriculum for my class largely on this book. It will cover, and it's, 200-300 pages, if even. But it's written by a guy who traded options on the floor and then found a bit of a better home in research and education. And man, was that his gifting. Natenberg explains the option trading process in a way that is both familiar as far as the language used. He doesn't try to get into a lot of really complex language, although the option trading at the level, he's training people who intend and want to go down to the floor and trade, or who want to trade options and derivatives for investment banks. So there are things that he has to cover that I don't have to cover on this podcast, mostly because this podcast is typically for retail investors, not for guys who are on Wall Street. If you are on Wall Street and you listen to the show, that's fantastic. It's great. But there's a lot more. It goes deeper. There are other things that you guys should be focused on, like staying delta neutral or covering your gamma and that sort of thing. And we don't get into that on this show because most retail investors aren't trading delta neutral. They're not trading the way you trade. So option pricing and volatility will teach you about synthetic positions. When you understand synthetic positions, you'll be able to sometimes exit out of, it's always a matter of wanting to, like, how do you put on a risk position? And when you understand synthetic options, you are able to have more than just one way to make your portfolio perform the direction that you want. So let's say, for instance, that I want to buy a call. Well, buying a put and hedging it with stock actually creates the same risk payoff, right? The same payoff financially as buying that call, and the put option may actually be cheaper than the call. So there are all sorts of things that you learn in that book that may or may not apply to you, but it's a great place to start. It's a book that isn't super big. The language isn't overly complicated. And if you have any questions, of course, you've got my email address, so you can definitely reach out to me. And for those of you who have not emailed me, I really do offer myself out as an advisor. I haven't charged anyone except for a couple hedge funds. I've not charged anyone for advice. If you're a retail investor, I'd love to help you. If you have questions or if you want to learn more, just email me. Second book that I'm going to point to, this is a much bigger book. I'm looking at it over my shoulder because it's on, all three of these are on my bookshelf. In fact, I have multiple copies of them because sometimes I just give them away. The next one is Options as a Strategic Investment, and that was written by Lawrence or Larry McMillan. It's a thicker book, but it's full of great information and great explanations on the options market. Now, I'd be impressed if any of you read it from cover to cover. I tend to use it as a reference guide at this point. I did read it years ago, but it's mostly reference for me if I want to make sure that I'm looking at a position correctly or even considering the risk fully. This is a great book to start with as well. Again, it's going to get into areas of option trading that I won't cover on this podcast, but that doesn't mean that it's not a good thing for you to be familiar or at least know them, or have maybe you find use for using the Greeks in your own trading. I do actually take a lot more time to look at volatility in my own trading. And the reason I don't cover it on the show, and I responded to an email recently, is that volatility is it's a mathematical concept, right? It's one of those, it's sort of a bit of a rabbit hole in how we look at volatility, how we calculate it. And that, again, it's not really it's not needed for this show and for even trading the way that I speak of trading on this show. But in all of these books, you'll get a much deeper explanation of that concept and the risk, the Greeks as well. So the final book I'll point to, and I'm using it as number 3 because it is an amazing book. I love this book. I've used this book both when I traded on the floor and as a personal investor, and I also used it at an investment bank, which is probably key to the fact that, or a good indication of the fact that it is a more complicated and complex book. It's Options, Futures, and Derivative Securities by John Hole. This book is a fantastic book as well. Depending on whether you buy a paperback or the hardcover, it's not a very overwhelming book. It's literally half the size in pages as that last book I mentioned, Options as a Strategic Investment. But this book is used by many top top business schools and many of the top investment banks on for financial structuring or financial engineering. In fact, I worked at one point on a trading desk that wrote. We created exotic options. There are all sorts of. So we talk about sort of plain vanilla or sorts of other options that kick in at a certain strike and also knock out, and then you'll have double-barreled options. You'll have all these exotic options, and we actually use this book on a daily basis to make sure that the models, I oftentimes had to build new financial models to price the new derivative that our customers were asking for, and we use this book heavily. So it is not a light book, but if you want to, if you are more quantitatively geared, if you are comfortable with some math and some higher level concepts, it's a great book. The chapters on option spreads and option trading are great. Just know that this book goes much deeper, and I would never want to push you away from option trading just because you don't understand the concepts in a book like this. You don't have to know everything, right? Like, you probably put on shoes and lace them up or slide on some loafers and wear shoes every day, and you couldn't tell me how to actually make a shoe. Many of you couldn't tell me how to polish a shoe, which is fine, but you're still able to wear shoes every day. So I look at this book as being like a shoemaker, and this podcast is about wearing shoes. So just know that if you get that book and you're like, what in the world? I'm not smart enough for option trading. That's not true. You don't have to be smart enough to be a financial engineer in order to make money trading options. So that's it. Those are 3 books that I love, that I suggest. Whenever people come to me and ask me how to get a job in trading, I've had young people ask me this often. I typically will either refer them to or literally buy them a copy of the Option Pricing and Volatility book by John Natenberg. Actually, it's not John Natenberg. I forget his first name. Sheldon Natenberg. And then I normally will tell them, read this book, come back to me, and we'll have a discussion, and I'll make some introductions for you, knowing fully well that if they even have a passing understanding of this book, they can get hired. So you're learning the way the pros do. So let's look at this week's trades. Obviously, yesterday, Friday, July 19th, was July expiration. So all of your July positions at this point are no more. They either have been valued at 0 and expired worthless, or they expired worth their intrinsic value, and hopefully anything that you sold went out worthless, and anything you bought had some intrinsic value at the end. And this week should also be a little bit of redemption. Last week I had a 3-for-3 trade loss. It's a little better this week. So we'll start off with the covered call. We looked at McDermott International, symbol MDR, Michael David Richard. Stock at the time was trading for $10.49. And we looked at buying that stock and selling the August 11 call at 70 cents, hoping for an 11.5% return in 5 weeks. Well, McDermott International stock closed at $10.43, so it was lower by about 6 cents per share last week. The option which we sold can be repurchased for 60 cents, which marks a gain of 10 cents on the option. So that means overall our net profit on this trade is 4 cents per share, or I know you can't wait, $4 whole over the week. Now, I would rather make money than lose it for sure. And this stock didn't have enough of a move up or down to really justify closing it. So unless you really feel like it's much less likely to yield the end return that you're hoping for over the next 4 weeks, I would just stay in the trade. I mean, if you close the trade now, hopefully you'll cover, your commission, or most of it, your brokerage commission to put the trade on. But again, there's no real reason to exit this if you decided to get into this trade unless you believe the outlook of the stock has changed. Now, next we're going to look at our credit spread. We had a credit spread on the Semiconductor ETF, SMH, Sam Mary Howard. At the time, the stock or the ETF was $114.25 per share. We looked at selling the August 113 put spread and collecting 34 cents, which also yields a maximum possible loss of 66 cents. So whenever we sell these spreads, it's always important to know what you could lose in the spread, just so that you're able to size your trade accordingly. Now, SMH ETF shares fell. SMH ETF shares rose actually $2.21 this week, ending the week at $116.46 per share. The out of the money put spread, which we sold, is now even more out of the money, so that's great. We sold the spread at 34 cents, and if we were to try to buy it back in using the end of the day pricing on Friday, it would actually be a 2-cent loss. We'd have to pay 36 cents to buy it back. Of course, if you tried to sell more, you would only receive 25 cents for the spread. So even though the bid-ask price on the spread is a bit wide right now, we know that the spread is worth less money because it's $2 more out of the money than it was when we even put it on. So chances are on Monday that pricing would be fixed, will be fixed, and we'll give you an opportunity for those of you who want to exit or at least have a better mark-to-market profit. So if prices stay high over the next week, we will see the spread depreciate more and more. It's going to move further and further out of the money, and it's not going to be worth anything. So showing a profit, it'll if it moves, it'll definitely show a profit for our short spread position. I would actually stay in this position, and I know it's hard to stay in some of these trades, but you have to let time pass so that these spreads that you sell will actually reach their full value. Your full value on this spread is the 34 cents that you collected when you sold it. So if you buy it back for even 28 cents, and you're like, hey, I made 6 cents, $6 per spread, depending on the number of spreads that you put on, maybe that's great. But if you just hold it and prices stay above $114, this spread will exit at zero, and you'll collect a real $34 per spread that you sold. So it's great to take money off the table. You won't go broke taking a profit, but you won't get rich taking your profits too early either. So for this spread in particular, I would look at staying in the position unless, of course, this ETF changes direction. So be aware, once this spread is making the move, it's made the move that you want it. If prices start to head back towards that $114 value, you want to look at exiting the spread or selling something against it, or buying something for that matter, that will appreciate so that you can lock in some profit. It's all about locking in profit. And then our final trade for last week was that debit spread that we did on the Spider Gold Trust ETF, symbol GLD, George Larry David. At the time, the stock was trading for $133.53, and we looked at buying the August 132-133 call spread for 61 cents, which yields a maximum gain of 39 cents or 63%, almost 64%, if the stock stays above $133 over the next 4 weeks. Well, the Gold Trust ETF rose 94 cents per share this week, closing at $134.47. The in-the-money call spread, which we purchased, is even more in the money now. That means this spread should be worth more money, so that's great. We made some money. We know we got the move that we wanted, and this spread is worth more money. However, of course, if you tried to close it right now, just like with the credit spread, you would only receive 50 cents for it, which we know is incorrect. That'd be a loss of 11 cents. So do not exit. Don't try to exit this spread on the open on Monday morning, not until they reprice everything. If you tried to buy more of it, it would cost you 65 cents, which is a few cents more than what we paid for it. So this is just mark-to-market pricing at the end of the week. A lot of times the next month, which is August, gets sort of overlooked a little bit on options expiration, but on Monday everyone will have their full focus on these August trades, and so the pricing will be much better. So if you want a real value or real understanding of what this trade is worth, these two spreads, look at them at the end of the day on Monday, when the market has had a day. It's had a little more time to focus on adjusting volatility levels and really pricing these spreads and the individual options where they should be to reflect the amount of money that's worth it. So just as an example, in owning the August 133 call spread, you actually own the August 132 call, right? So that call right now alone, that call is $2.47 in the money, right? And we also know that right now, the call that you sold, the 133 call, is also in the money. So you sold it in the money call. That call right now is $1.47 in the money. So the $2.47 in the money option you own, and the $1.47 in the money option you sold, means that right now, today, at these prices, this spread is worth $1. Now, no one's going to give you $1 for this spread, mostly because there's still 4 weeks left. So there's always that time value associated with options, and that's why it's important to wait. But because I know that this stock moved 94 cents in our favor, I know that it's worth more than the 61 cents that I paid for it a week ago. So that's the way I look at options trading. If you guys are ever confused about the way that I communicate it, just email me. I almost said call me. Email me, and I'll definitely try to explain it to you. But if you own something that's worth $2.47 and you sold something worth $1.47, that means that what you own is actually worth $1. And so it's just a matter of capturing that full dollar, or as close to you can on that full dollar if you decide not to hold it to expiration. So that is it for last week's trades. Of course, I already said that yesterday, Friday, July 19th, was options expiration. So we are fully looking at August trades. August has 4 weeks left until expiration. So let's dive into some new trade ideas for the week. So we'll start off with a covered call on Knight-Swift Transportation, stock symbol KNX, Kevin Nancy X-Ray. The stock closed the week at $36.98 per share. I'm looking at buying that call and selling buying that stock and selling the August 40 call at $1.05, hoping to yield an 11% return in 4 weeks. Now, you enter this trade by buying KNX stock for $36.98 and selling the August 40 call at $1.05.
This trade makes the most money if stock prices finish above $40 per share, and the break-even price on this is $35.93. Our next trade is going to be a credit spread, and I'm looking at another ETF this week. I love ETFs. I think I've shared before, my background is in ETF trading on the floor of the CBOE, and I've always been a fan. So we're looking at a credit spread on the iShares MSCI Brazil ETF, symbol EWZ, Edward William Zebra. ETF, or shares on the ETF, ended the week at $46.02. And I'm looking at selling the 46.45 put spread at 36 cents. And that yields a maximum possible loss, or creates a possible loss of 64 cents per spread. So you enter this trade by selling the August 46 put at $1.25 and concurrently buying the August 45 put for 89 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices finish above $46 per share. We are selling a put spread, so we definitely want prices. We want stock to go up and stay higher. The break-even price, of course, on this trade is $45.64. And then our final trade for this upcoming week is a debit spread on Uber, symbol Uber, UBER, Uncle Brian Edward Richard. Stock ended the week at $43.18 per share, and I'm looking at buying the August 42.43 call spread for 65 cents, and that creates a maximum gain possible of 35 cents, or a 53.85% return in 4 weeks. You enter this trade by buying the August 42 call for $2.75 and selling the August 43 call at $2.10. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices stay higher than $43 per share. The break-even price on this is $42.65. So that's it for this week's show. I am working on some new training, actually new free training that I can offer you guys, my listeners. I love that you guys tune in each week. And going to be creating a newsletter here in the next month. So I'll announce those in the coming weeks as they are ready. Thank you so much for your listening. And if you have friends who like option trading, I would love it if you share the podcast with them. I love speaking to more people, and this show has grown so much more than I even would have imagined. And that's why I enjoy making these recordings for you guys. So keep listening. Of course, if you have any questions about anything said on the show, just reach out to me on my email, eric@theweeklyoption.com. That's it. Have a great weekend. Happy trading. Oh, actually, before we go, I did want to give one caveat to all of the trades on this show. So the trades given this week on these shows that are done on expiration weekend, just take them with a grain of salt because everything's going to get repriced on Monday. So as of the open on Monday, July is gone, and on the week of options expiration, the market makers really have to focus on what's happening to pricing in that last week, because the time value is disappearing so quickly that the values of the options are sort of moving all over the place. Once they have their full attention on August, all of the prices will be adjusted, and bid-ask spreads will be tightened, and all sorts of good things happen. So you could execute these same 3 trades on Monday morning, but what you might find is that there are other trades, like you might be able, instead of buying the 42-43 call spread, you might decide to buy the 42-50-43 or the 42-42-50 call spread. That might be priced a little better than the 65 cents that I just mentioned paying for the spread. So just, write these down, look at the pricing on Monday morning, and look for trades that fit your risk sensitivity. All right. Have a great weekend. Happy trading. Bye-bye.
Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.